Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really interested in trying to help people have a better retirement, right? I mean, that's our main objective. And we do a question and answer. So this is really kind of your show. You can send in questions at any time that you'd like. You can send them into the Ask Tom at talkmoneywithtom.com. You can put them into the chat here. You can send them during the week. My clients ask me questions during our meetings that I'll bring up also. And so really, kind of robust issue. But if you think of something as something current that's happening that you want to ask us, please do. Feel free to send that in. Mainly we talk about, what's going on in the markets. We talk about really, retirement planning, tax planning. Those are the three main subjects. So hopefully we can help you there. We do believe, and one of the reasons we launched this channel was that, our clients and the public can have potentially a better retirement by just understanding more. If they can get to a spot where they kind of have more understanding like we do about what to do here, then maybe things go better. And so if you want, you can subscribe to this channel. You hit the subscribe button, the little bell that's right next to it. You get notified, if we put something on there. Right now, we're kind of working towards 1,000 videos on this channel, so we're really happy with the content delivery of what we're trying to do here. So feel free to take advantage of that. And of course, if you'd like some more custom, information just specifically about your situation, you can always book an appointment. You go to our website, which there's a link here on the channel, and there's a book appointment button. Looks just like that up in the corner. You click on that. You can pick a half-hour time for a phone or video appointment to meet with Ethan and I, and we'll go over your scenario, see if there's something we can help you with. So, really looking forward to today's show, and I hope everybody gets something out of this today. Of course, I always like to start off the show with a summary of what I've seen happen in the stock market this week. And of course, this has been an unbelievable week altogether with what's happened. The market's been very volatile, lots of things going on with inflation, the Federal Reserve, and what have you. So I want to break down kind of what I saw happen, some of the reports that have come out, and just give you some opinion on, what the market, I think, is looking at right now and what we need to focus on coming forward. So we'll start off with just kind of a chart like I normally do. Here's the S&P 500 so far this year. Down about 22%, unfortunately, in this particular time frame. But you can see what's happened since our last show, just last Friday. We've had kind of this cascading down motion, little bit of stability here, recently, up a little bit today, for example. And so, I'm going to break down kind of why I see this happening, but then also kind of show you some of the things that are coming up now that I think are important to pay attention to. So, first of all, this is the leading economic index, this blue line. The gray line is actually the concurrent economic index, which just means it's kind of the current economy. Pay attention to that blue line because it's really important. This report was just released today for May. And so if you look back all the way to the early 2000s there, you can see that when that blue line peaks out, oftentimes within a fairly short period of time, 18, 20, 12 months, we start to see a gray bar coming up, which signifies a recession. And it's very important in this type of market to understand that, if you combine a downturn with a recession, the downturn could be much, much higher, like we saw in 2000, like we saw in 2008. So even though we're down so far right now, maybe we come back around if we don't have recession. Well, if you look at the most current end of this blue line right above me there, you can see that it's showing a little bit of weakness, right? And so it came down 0.4% in May. They readjusted April and March, so the peak is now in February, and the drop from the peak is 0.9%. So it's starting to get into a range that's starting to signal the possibility of recession as far as that goes. So important to keep track of that, respond to that, and understand what that means, in my opinion. Now, I do follow a couple of other recession indicators, and I'll show you those just really quickly. I've covered these before. This is the Clear Bridge indicator. They actually break out the 12 pieces that they use. The leading economic indicator uses 10 pieces. They put a green arrow or a yellow circle or a red X, depending on where they see it in terms of recession indication. this is the last 3 months. And so you can see, we've had this red X under wage growth all the way through, but the number of yellow dots there is starting to grow, again, showing some weakness, but the overall indicator is still green. You can see that little arrow right at the bottom. And we probably have a ways to go before this is going to start flashing future recession on the horizon. We do get this again every month, so we'll find out what happened in June, really in early July. They actually update this quite quickly, which is nice. The other big one that I follow is the spread between the 10-year Treasury bond and the 3-year Treasury bill. So theoretically, you should always be making less on a 3-month bill than you would get on a 10-year bond, right? Sort of like a CD. If you went to the bank and said you invest for 3 months, you're going to get a lower return most of the times than you'd get on a 10-year. Now, once in a while that inverts, and very high probability when it inverts. In other words, the 3-month pays more than the 10-year. And especially if that stays down for about 3 months and stays inverted for about 3 months, that you would end up with a recession in roughly the next 12 months. And so you can see right now, and this is as of yesterday, we're at about 1.7% differential in yield between the 3-month and the 10-year. That's pretty good. That's pretty good spread. But I would be I'm a little cautious because the direction. You can see it peaked out back here in May, and we've been kind of slowly but surely starting to compress that spread. So something to watch for. But of the 3 big indicators, the leading economic indicator is showing a little bit of weakness. The clear bridge is showing some weakness, but still pretty strong. This is showing, the yield spread showing some weakness, but still pretty strong. But these are things to keep track of and make sure you understand, because if we're heading into recession, you might want to do some things differently with your portfolio than you might normally do, and be at least more cautious, just because you can roughly double the downturn that you might have with a recession versus a downturn in the stock market without a recession, if that makes sense. And the recovery time can be quite a bit longer also, so definitely something to pay attention to. Now, just getting back to kind of what is happening right now and why, we've had this, kind of big cascading drop here, started last Thursday, and then on Friday, we got the Consumer Price Index report. We talked about this on the last show on Friday. Well, if you look at that, we kind of peaked out in March, and everybody thought, okay, April was down. The big hope was that May would be down also, and May was up, and actually was up higher than March. And so the market really responded to this. It wasn't supposed to be down a lot if you look at the consensus estimates, but still supposed to be down some, or at least flat, and that didn't happen. And so the market looked at that as a negative, because that is the big piece that the Federal Reserve is looking at as a whole, and really, worried that the Federal Reserve is going to have to do a lot more rate increases, which the market looks as a possible negative if they're not careful. So here's why I think some of the things have happened since the Federal Reserve announced their increase. So they increased the rates by 3/4 of a point on Wednesday. The expectation prior to this week was that it would be 0.5%. Once this report came out, we started to hear about 0.75%, which is pretty rare. The last time that happened was 1994. So it's a big increase. It's not something you do very often. And one of the things that I think was very interesting in watching the conference that Chairman Powell had in the question and answer was that he kept focusing on this. This is the kind of the top line inflation, includes everything. Well, that also includes energy and food, which the Fed constantly says they don't have as much control over. So the Fed often looks at what's called core inflation. And if you look at core inflation, so this is the same basket, just taking out food and energy, core inflation's down. Okay, so think about that for a minute. The thing that the Fed talks about all the time that they have control over is actually down. Peaked out in March, down April, down even lower in May. And they increased the rate from 0.5% expectation to 0.75%. So what are they responding to? And I think that's what the market's reacting to. And the market's also reacting, and I'll talk about what I think is happening here in a minute, but the market was also responding to the fact that the Federal Reserve kept talking about how strong the economy is, and they're right to a large degree, but didn't really acknowledge all of the different things that are starting to show softness. And so, if we look here, the producer price index, another kind of inflationary measure, peaked out right earlier. Here's the PCE, the personal consumption expenditure. This is the favored index for inflation for the Federal Reserve. They talk about this all the time. This is not up to date through May. This is just through April, so it dropped in April. So we'll see what happens with May. But again, no conversations about these preferred or core type inflationary things, just talking about top line inflation and trying to really reduce that. Jobs openings was the hot subject for the Fed meeting last month. They wanted to reduce job openings. There's almost two people looking, 2 jobs open for every one person looking. And that creates problems on an inflationary basis, so they wanted to bring that down. Well, it did come down some, not a lot, right? But came down. No acknowledgement of that. We actually saw unemployment claims, first-time unemployment claims, come up. So it's not a lot, but you can see there's a bottom there in April and starting to come back up. Again, those are things that are showing softness. We need softness. We need to slow down the economy because the inflation's too hot. And it looks like things are starting to happen, starting to work. Yet they increased their rates by the most that they've done since 1994. Kind of interesting. Here is retail sales, just reported really the same day that they raised the rate. And that was down a little bit. Not a lot, but down, which is kind of interesting because we've seen retail sales, as you can tell, been pretty healthy here. But consumers are possibly starting to respond to these higher prices, respond to the fact that the stock market's down, respond to the fact that they can't refinance their house, at a low rate anymore, as far as that goes. Speaking of low rates, here's the 30-year mortgage rate over the last year. You can see it's just really accelerating to the upside. And what we're having here is where it was nearly, 3% or less on average 30-year mortgage. It's almost double that now. And what that most likely means is some slowdown in the construction industry and the new home sales industry, which is a really big chunk of the economy. And you can see that here. Here's the number of permits that have been asked for new buildings. And of course, that peaked out back, at the beginning of the year, and it's come down quite drastically. So the market is saying, hey, things are already starting to go in the direction that the Federal Reserve wants. Probably not at the pace that the Federal Reserve wants, because they want to hit inflation faster and harder. But we got lots of evidence of core inflation coming down, lots of evidence of some of the different pre-indicators of economic slowing, like new building permits coming down, and no acknowledgement whatsoever about those in the meeting. And so what the market's afraid of is they're going to make a policy mistake. They're going to keep pushing and pushing and pushing on the interest rates, and all of a sudden kick us into a recession. And of course, recessions are really, really rough for the stock market. So that's why we're seeing so much volatility come down. Here's the other piece, and I mentioned this on Wednesday, and we've seen a lot of articles about this since, but gas prices. So for the first time I've ever seen, the Federal Reserve started talking about consumers' expectations for future inflation. This was done through a survey at the University of Michigan. And all of a sudden, consumers have decided that inflation might be a lot higher over the next 12 months than was previously. And Chairman Powell talked about that and said probably because gas prices are coming up. Seems fair enough. But he says he wants to get that number back down, and they're paying a lot of attention to what consumers think inflation might be going forward. But at the same time, many, many times during the same conference, he talked about not being able to control the gas prices. So here's the fear, is that the Federal Reserve is going to push on overall inflation to try to create a scenario where gas prices go down. And that is going to be very, very difficult to do without getting into a recession, right? And so this is going to be what you want to watch here. And because there is another actor in this, and that's Russia. So Russia can basically weaponize their energy by holding back deliveries. And there's already been news where they're talking about reducing the amount of shipments of natural gas to Europe, right? And Europe is trying to get off of Russian natural gas, oil, and coal. but they don't have great places to go. And you have a very tight energy market already because the economy is opening up faster than the production of oil and refineries of gas and those types of things could do. And so we've got this scenario where Russia could start to try to push on this, cut back on their oil, deliveries. Even if it hurts them, it creates a possibility of kicking a bunch of Western economies into a recession. So it's one of the things I definitely would be watching, and really watching the price of gas. There is one other component, obviously, of gas. This is a refinement of oil, so it takes refineries to do this. And a lot of refineries were closed down during the pandemic and have not completely reopened yet. That is happening. There was some news about refinery opening up in Kuwait, for example, and those types of things. But it does take time. And so there's this kind of lag right now where the market's looking at this and saying, wait a minute, the Federal Reserve is going to be aggressive trying to reduce gas prices, which they really don't have as much control as they probably wish they did. And we've got this other scenario where gas prices have a high likelihood of going up, and we've got a seasonality situation with the summer and all those types of things. So really, really interesting what's going on right now. Very different, and I think that the market is very worried about what the Federal Reserve is talking about right now. They're being extremely aggressive in their thoughts and talking about fighting inflation, which is fine, but then they started to go off into some areas of trying to fight things that they don't have that much control over. That, I think, worries the market. So, these are things we're going to have to see how they play out, but I do see enough pieces here between kind of what happened to the price of the S&P 500, what happened with the leading indicators and the pre-recession indicators that I'm watching, to say that we should be more conservative here in this environment. If you're younger and you want to go out and buy some small stocks and you got a 20-year time, go for it. Probably a great time to do so, honestly. But if you're like most of my clients who are near or in retirement, looking for income production or living off of those assets, I would think you want to be a little bit more cautious here, just as far as that goes. So this is something we'll continue to work on within our portfolios, just to try to kind of dial back some of the possible volatility, just in anticipation of what might happen. I would love to see what's going to happen with gas prices here. That's one of the things that's, I think, really driving this at this point in time. So great time frame to be paying attention to the market, because, boy, you can really learn a lot here about investing from what's happening now and how things are related and how they connect together. So thank you very much for watching my summary this week, and look forward to, again, talking to you next week. All right, Eason, let's get into the questions. And what do we have today?
So how long will the bear market last?
How long will the bear market last? Okay. This actually came up in one of our client strategy sessions. So we found some information, and this is something I've talked about actually over the this year, especially as the markets come down. Some of the history and what happens, and it's really kind of interesting. So let's take a look at this. I've got a little chart here. There we go. All right. So this is from MarketWatch. It was from an article where they did some research looking back, and with World War II, so 1946 to now. And this is a little out of date, only because we actually have just had a bear market, and I'll point that out in a minute. But we have a 5 to 10% drop 84 times since the end of World War II. So if you think about it, I think it's about 76 years since the end of World War II. Mm-hmm. So more than once a year. Mm-hmm. So pretty common. Recovery time average is 1 month. All right, not bad. Still, go through lots of those. We had a lot of those last year, at least close to them. 10 to 20%, which is what we had for most of this year up until this week. There's 29 of those. So, what's that? About every 3 years, give or take. 4-month recovery, not bad, right? The next one's pretty rare. That's where we are now, 20 to 40%. And we're just very at the top of that, 22%. And there's now 10, including this one. Yep. And the recovery time is 14 months. So just to answer the question, in a brief sense, the average recovery time in a bear market, which would be more than 20%, is 14 months. And so, we have a ways to go to kind of get out of this as far as that goes. And then the very rare downturns, the really big ones, 40% or more, there's only been 3 of those: 1973, 2000, 2008. And that has a 58-month recovery.
Oof.
Yeah. So, again, that's good information. But for me, one thing I focus on the most in my portfolio development is that big downturn. I believe that we should try to ride through pretty much everything else and have the right stock and bond mixture, maybe move some little target pieces once in a while to try to take advantage of trends that you see happening, rebalancing, those types of things. But the problem with these big downturns is that they're so long for recovery. Again, if I'm 75 and I'm living off of my retirement assets, that 58-month recovery is going to be brutal.
Yeah.
And they've been through it. I've got clients, they've survived through 2008, that type of thing. But that's why I'm really watching these recession indicators, because all of those had a recession attached to them, combined with, some pretty serious marked downturn, motion. And so that's the thing I'm looking at right now. Are we in this just kind of standard bear market with a 14-month recovery? Then you kind of want to, rebalance and just kind of take advantage of that, because 14 months isn't that long. It's going to seem longer, believe me. But are we going into this bigger downturn, this 40% plus type of thing? Are we going to add a number to that? Is that going to be a 4 instead of a 3? And the one thing is that although the economy is starting to slow down because of what the Federal Reserve is doing, it's still pretty hot. And so theoretically, the Fed could push the brake, on the economy, hopefully bring inflation down to a certain point, and not kick us into recession, right? But the market's worrying about that right now, let me tell you. And there's a big battle of debate going on as to what might happen here. But that's important to kind of understand the stats of the market, in my opinion.
Yeah, where do you put the pandemic kind of downturn? Because that was such a quick downturn, but the recovery was also so quick.
Yeah, well, it fits in that there was 20 to 40%, because it was down 35%. And so it was one of those 9. And the recovery was faster than 14 months, but 14 months is the average. So you're going to have, some at 20 and some at 10, whatever it might be. And the pandemic was kind of unique because it created a response from the government that was so dramatic. And that's what we're paying the price for that now, right? I mean, the amount of money that came out in stimulus from the Congress, the Federal Reserve, the Treasury, I mean, it was unprecedented. We'd probably be talking about Great Depression if they hadn't have done it, in my opinion. And so there's a lot of people worrying about what's happening right now. If we could run a parallel universe where they didn't do all of that stimulus, you would be talking about something else. Because we got up to, 15 million unemployed people overnight. We're down to, 5 now, give or take. So we've reabsorbed, people back into the workforce at a pretty good clip. There's, 2 jobs open for every one person looking. I mean, it's a pretty strong scenario altogether, but there is a price to pay for that too, and that's what we're paying now. So pandemic fits into that, last one. This one's different because this is more of a potential financial issue. Depends on what the Federal Reserve does, and so there's so much emphasis placed on looking at what the Federal Reserve is saying. And I tell you what, this last meeting, I thought they said some things that didn't make sense to me, really for the first time. And also one of the problems for the Federal Reserve, in my opinion, is over the last 12 months, the market has been saying, hey, here's how much rates are going to increase. Here's what's going to happen. Here's what's going to slow down. The market's been much more accurate as a whole than the Fed. Because from their reports, they were saying X, Y, and Z. The market's saying, nope, it's going to be worse than that, or higher rate increases, or whatever it might have been. The market's been right, and the Fed's been wrong. So the Fed's continually trying to catch up And of course, what you have seven, I can't remember, 7 or 8 essentially economists, public servants, so to speak, running the Federal Reserve, one of the more important portions of our economy. But the market is made up of this just ginormous, money machine, and lots of money is being placed into trying to see where things are going. And maybe the market's a little bit better at it than the Fed. So we'll see. But anyway, that's a good question. 14 months is the answer, but we really hope we don't get to that 58-month one. I don't want to add a number to that 3. Let's keep it at 3. Be my preference, but gotta be aware. All right. So what's the next question?
So the next question is, what is stagflation versus a recession?
Okay. Start with recession. Maybe that's easier to kind of go. A recession is a contraction in the economy. And it's defined by 2 quarters of gross domestic product. So that they measure the overall economic growth under something called GDP, gross domestic product. And it's a big number and it's a huge thing. But how much does it grow on a percentage basis, quarter over quarter, and even year over year? And a recession is where 2 quarters are negative, right? So the economy is contracting and going the wrong direction. In a recession, you normally do not have inflation because the economy is slowing down. And if anything, you might have more chance for deflation where prices are dropping faster than people want. And so that's a recession. That's what most people are talking about as a possibility, but there is a pretty good sized group of people talking about the possibility of stagflation coming up. The last time we really had stagflation was in the late 70s and early 80s, and that is where you have slow growth of gross domestic product or negative growth of gross domestic product, which would be like a recession, but you can also have just slow growth, really low, and you still have inflation. So even though it's not growing very fast or even shrinking in terms of the economy, inflation's still coming in, right? And so, one of the things that's pretty obvious that causes something like that, oil prices just go, 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 go. Theoretically, it should drop when the overall economies all start to slow down, but there can be supply side issues where there are just not enough oil coming out to even meet this slightly lower demand, and it still brings the price up. And so when you see, food and energy is a big piece of the consumer price index, certainly the part that's really moving the most right now. And so that's where you can have stagflation. And we do kind of have those potential issues coming at us. If you think about it, food, we're having trouble with wheat getting out of, Ukraine. And so that could create a scenario where the price of food is going up, even if the economies have started to slow down to a pretty low level or even contract. And of course, Russia could cut back on oil, or Europe could try to cut back on their use of that oil, and in so going over to other places really jack up the price because now they're bidding, hey, we don't want Russian oil, we want this other oil. And so they're, bidding the price up. And so, obviously one of the things that can happen there is Saudi Arabia could step in. They have said that they would be willing to step in and replace a Russian loss of oil. So, we'll see how that plays out. But those are scenarios that can cause that stagflation. Still have prices going up, even though the economy is very slow growing or shrinking. And that's a tough scenario because, generally speaking, wages aren't doing well there. Stagflation is often associated as a recession is with higher unemployment. And so higher unemployment, the employees don't have the leverage like they do now. Employees have leverage right now. 2 openings for every one person looking for a job gives leverage to that one person, theoretically. And so, wages aren't growing, but your costs are growing. That's basically the misery index, right? So that's what we're going to see how this all plays out. It's a pretty tricky road that we're on right now, so we'll see how this goes. But that's the difference.
Is one of the major issues with stagflation is that the Fed kind of runs out of tools, because if you raise interest rates, you're causing more and more unemployment.
Yeah.
And so you can't control the standards inflation with just raising rates.
That's right. And that's exactly right. And at least in the 70s and 80s, the parts that with oil, because OPEC basically did a restriction and created this big problem. Yeah, there's only so many tools that the Federal Reserve has. And so theoretically, there might be more interest in trying to do stimulus to get jobs going and what have you. But of course, you do that, you get higher inflation still. So personally, just my outlook, I think we just need to live with some inflation here at a little bit higher level. They're determined, at least in their words, to get back down to 2%. I think it ought to be a slower glide path to get there, and maybe get down to 4 for a while, and then 3, and trying to get down to 2 even by the end of next year. It's going to be really interesting to see. It's going to take quite a few things happening the right direction in order for that to happen. So, but we'll see how this plays out. Good. What other questions do we have?
So our next question is, what is the VIX? I keep hearing about it in the news. People are always talking about the VIX whenever there's kind of like this turmoil in the market. What is it? All
right. So the VIX is a fear gauge. Okay. Let me share a screen with you here too. We had this shot before in one of our other shows. So it's actually a fairly complicated measure. I'm gonna really hit the high notes. What it does is it measures the number of puts versus calls that are being sold on a short-term basis against S&P 500 kind of futures contracts. And it's done by the Chicago Board of Options Exchange. But in essence, what it does is it shows fear. When more people are buying puts, that means they're basically trying to protect their portfolios, right? Mm-hmm. When people are buying calls, they think things are going to go up and they're going to make money on that, right? So again, don't want to get too complicated, but what happens is when you see the number go higher, that means that the fear is getting higher. They're buying more puts. And I put some little boxes there on some of the high points this year. Historically, 33 and above, right? When it gets to 33, and again, it's just a number, that's been a good time to buy stocks. Mm-hmm. So this is sort of a contrarian indicator that says fear is high. When fear is high, I buy, right? That's the contrarian mantra as far as that goes. And so it is a way to kind of see what fear is happening in the market altogether. I think it's pretty interesting. Mm-hmm. And I look at the VIX every day, all day, really, just to see what's going on, just to see how this might play out. But that's what it looks like. It's been, all over the place, but it's hit some high points this year. Mainly, what are we, 1, 2, 3, 4, 5 there, kind of in that 30 to 36 range. Mm-hmm. That's not that normal because this has been a down market with lots of consternation because of inflation and what the Fed is doing about it, right? So that's what the VIX is. It's definitely something to know about, and just at least have a cursory understanding of what it is. There's lots of different measures for fear, but this is one of them.
Should I, as a normal investor, should I be following this, or kind of like as an average, person that's just looking at the market, should I be worried when the VIX is high?
Personally, it depends on how the market plays out, but we've been using these as points to rebalance, mm-hmm. right? And so when the fear gets high, generally the price is kind of stretched down, and we have another measure that we use for that, the Wilder's RSI. And when those two happen together, we use this to rebalance. And so we're basically picking points to kind of buy the dip as far as that goes. But it kind of depends. You just got to be careful. I mean, we end up with a 50% downturn or something along those lines. Buying the dip all the way down, again, if you're young, why not? Mm-hmm. That works. It depends on how long you have, how much tolerance you have for risk. You can do quite well with this. But yeah, I think it's at least a short-term gauge to show some bottoms, right? Mm-hmm. And that's what I would look at it for. If I had some money I was thinking about investing, and all of a sudden the VIX jumped to 33 or higher, I might say, okay, especially if I have a long-term outlook, okay, now's a good time to buy, right? Because it generally works. When everybody's running one way, the best investors run in when everybody's running out, right? And that's what this is. Basically, the market is running away when that number gets high, and you're walking in and buying at that point in time, right? And so, certainly takes some courage as far as that goes, but it works. It has worked anyway. All right. Other questions?
So our next question kind of VIX led into that. What is contrarian investing?
Oh, okay. Well, let's actually go back to this slide again, and we'll share it in a way like this. So contrarian investing, when the fear is high, you buy, right? Just think of that. When the fear is high, you buy. Now, the most amazing thing you'll find is that the average person is doing exactly the opposite, right? That's it. That's the difference between professional investors and average investors, is that they have a high enough understanding of how these things work that they're actually more interested in buying when things are falling than they are of selling. So, this is the buffer that I think we provide, or advisors provide with, our clients. I know that there's a lot of people out there say you don't need an advisor, you can go do all this stuff yourself, and that's true in today's world. But one of the things that does happen is oftentimes people on their own will panic, whereas a professional manager like us, who've been doing it for over 35 years, would look at that and say, okay, this is the time to be actually buying right now. And maybe it is time to panic, but here's why, and here's the facts and the data and the research that goes behind that, where it's time to pull back some of the stock pieces. I mean, that can happen too. But so VIX is one measurement of fear. So when that gets above 30, 33, that's a contrarian sign to buy. The fear is high, buy. Here's another one. This is the American Investor Sentiment Survey, American Association of Individual Investors, AAII. And this comes out every Thursday. So this just came out yesterday. And you can see here the bullish is 19.4, which is very, very low. If you go down below, the historical average is actually 38%. So it's half what it normally is. And what they're asking is, very simply, do you believe the stock market's going to be higher in 6 months or not? Well, 58% think it's going to be lower. That's a pretty big number compared to, again, 30%. So it's almost twice as many people, of course, think it's going to be bearish. Again, using this as a contrarian indicator, you can see this little dial right above us. It's at negative 39. And so basically greedy means the farther that gets over, the more you should be buying if you're a contrarian and you're coming in and buying when everybody's leaving, because the fear is getting high enough. Versus fearful, which is where, everybody's buying, and you're starting to get nervous that, that's going to peter out, right? Because it does peter out either way. Everybody sells and sells and sells, and pretty soon they're done, right? And then the only thing left are the buyers to come back in and move it over. And that's essentially what the contrarian is relying on. And there's one more measure here. And this is, we just saw this today. This is the B of A bull and bear indicator. This is a proprietary indicator that they have, but I would assume it's a basket of different contrarian indicators that they're looking at. It's extreme. It actually went from 0.2 in this chart to 0. And so really, people are super, super bearish right now. I mean, and again, what that means is, theoretically, that all of these people have made their moves. They've sold and sold and sold, and that leaves the few buyers that are still out there, the contrarians that are coming back in and buying that dip, and they might have an outsized impact on the market because there's nobody on the other side anymore, and so pretty soon there's a lot more buyers than sellers, right? And so that's what that's talking about when they talk about being a contrarian. It's coming in, and long term, this is a really good strategy. And some of the best investors in the world, Warren Buffett's been buying recently, right? Mark Tobias with Franklin Templeton. There are people that are really, really good. I mean, again, They're walking in the door when everybody's running out. So that's where we're at right now. Now, you have to be a little bit careful because your situation might be different. What's the timeline you need this money for? Because things could continue to do poorly for a while.
Mm-hmm.
I'm going to buy a house at the end of the year. Well, you should not be walking in when everybody runs out. You probably shouldn't be in there in the first place, right? That's too short of a goal. I see that all the time, by the way. And so, that type of thing. Hey, I'm 40 years old. I'm going to retire at 65. I hope I'm going to live to 90. Well, okay, you can suffer some loss and you can keep buying those dips. Be brave, all the way through, because heck, even the Great Depression came back in 14 years. Mm-hmm. And so there's a chance that you're going to come back in your lifetime, even probably before your retirement. So your age, your outlook, your risk tolerance, what your cash flow situation is like, how much money do you have on the side that you could live off of if the market didn't do well for a while, will really determine how much of a contrarian you can be. You have to be careful.
And the market's never gone to zero, and so it's but you also want to take some kind of, is this within my risk tolerance? Because if you take on too much risk and you stop sleeping at night and you're looking at the market constantly and seeing red and it's giving you anxiety, then this is not a strategy for you.
Right.
So there has to be a balance between what you can handle, what you can stomach.
Well, one other key component here that we didn't talk about was just, what are you buying? Mm-hmm. Okay, so everybody's running away from this little company that doesn't have any earnings, barely has any revenues, and you're running in the door on that. That's a totally different deal than, hey, everybody's running out of the S&P 500, and you're walking in and buying the S&P 500.
Yep.
Because that little company can go out of business, right? We've seen a lot of them go out of business. And so, if you're going to do that, at least buy a basket of little companies, maybe an ETF, Russell 2000 or something, if that's really what you want to do. If you're going to do the little company thing, make it small, because if it works, you'll make money, but there's a contrarian thing where you're just running off of a cliff that there is no bottom. It goes to zero, and your portfolio goes with it. So I do think that needs to be understood. When we're talking about contrarian investing, you have to be a little bit careful about what you're getting into as far as that goes.
And like Warren Buffett, he tends to buy quality companies that are down, kind of on the down in their cycle.
Yep.
And so he's not buying these small companies. He's buying, Coca-Cola. He's buying all the big companies. And he feels there's value to be had by when they rebound back up.
Yeah, exactly. I mean, I always tell the story about bingo.com. 2000, 1999, whatever it was, client calls up, wants to buy bingo.com. So I look it up. It went from $1 to $9. Like overnight, 6 months. Huge rate of return. This was, the .com bubble, no doubt. And so I look into it. It doesn't have the ability to do. They never got approval to do bingo online, but that's what they're trying to do. They just filed a public offering, and so then it started to fall. It had come down to like $8, and this client was excited. Oh well, it did so well, made some money. The online, bingo is going to be hot because it is popular, right? But they never had approval, so then they have a company. They didn't have revenue, no earnings, no nothing. It didn't have approval, so. Trying to buy that on the way down, it went to zero. E-toys, right? Big runner up, went to zero. So you gotta be careful on some of these, stocks. You're running into something. So keep those bets fairly small, in my opinion. Nothing wrong with making those bets; it's kind of fun, but keep them smaller. Yeah. All right. Good. Well, we're done. And so. Really, thank you for listening today. I enjoy doing this so much and trying to, provide some information. I hope you found some things today that were helpful, useful for, your own knowledge base, that you can, get better at investing, get better at your retirement planning, tax planning, and, even if you're relying upon an advisor like we are, like us. I find it so helpful. The more the clients know, the more they understand what's going on with the markets and all these things, it's just a much higher level conversation, and we can move a lot faster and be a lot more efficient as far as that goes. And so, that's what this is about. So again, you can subscribe, hit the subscribe button, hit the little bell next to it, and you can even book an appointment with us if you'd like, just going to the book appointment button on our website. So I want to thank everybody for coming today very much, and I look forward to being able to, talk to you again next week when we have our live stream then. Thank you.